again, to be long this one very basic factor, so there's growth. If you want to be long growth, you're killing. If you're long reflation or inflation expectations, you're getting killed. These are the two dominant factors in macro. I will argue to my grave, just because the macro market gods will agree with me, and it's really only an argument because some people are just not doing it like we do it, which I'm quite grateful of. You get these two things and rates of change right, you're going to get a lot of things right. Look at the style factor performance. So these are style factors. So instead of looking at a sector or a great stock idea, what we have is style factors. So what do you want to be long? You want to be long quality and growth. You don't want to be long some levered pig that's levered to energy prices. No, 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 no. That would make you up half of the return. So if you look at debt, and I look at low leverage, top row, top two, you can see that last week, high quality balance sheets, low debt to enterprise value was up 2% to up 14.1% for the year to date. So let me say this very clearly. If you're just long high quality, you're beating the S&P 500. You're definitely beating the Russell because the Russell's got a lot of low quality. So again, that's one very basic way to express high quality growth. And then if you just look at sales growth and earnings growth, which I think most people can understand, go back to the board one more time there, Josephine. You can see that last week again, they outperformed both the market, I'm talking about the S&P 500, the top 25% sales growers, you look under sales and EPS, the bottom two, really the bottom four rows, you can see there's a massive divergence between fast growers and slow growers, up 15.4 and 13.8% for the year to date, respectively. So again, being long growth has been the call. I mean, I don't know how else you could have great performance this year other than just running a long short hedge fund, not being long a ton of growth, but being short energy at the same time. I mean, that's another way that you could have crushed it. Or now, for the last 3 months, being long US growth versus short Europe. Pretty much anything in Europe. It can be value. There's not a lot of growth in Europe, as you know. But again, European banks have not done well this, coming out of the summertime. And that's largely due to some prevailing data that continues to be slower. Some people are like, oh, it's just the euro. Well, do you think the euro doesn't have anything to do with the data? But the reality is that the data in Europe has been weakening. This morning, and I know a lot of people don't agree with that until they have to, i.e. they're not positioned for that. Swiss GDP growth was reported this morning. You know Switzerland, for Q2, GDP was 0.3%. Is that Europe? I mean, I could have swore I read it 10 times this morning from Old Wall Media that we were at decade highs in European growth. This is the lowest level in rate of change terms of GDP growth in Switzerland going back to 2009. Just as a measurement point, Q1 was plus 1.1%. So they went from 1.1% to basically zero. You know what Swiss bond yields are this morning? They're below zero. The 10-year in Switzerland is minus 0.20%. Swiss bond yields, nailed it.